Welcome, everybody, to another episode of Resilient Riches. When we look at somebody who's been resilient and then goes into the corporate bond, most of the time they're going to entrepreneurship. They grow up, immigrant mentality. All of a sudden, they're opening up their own restaurants. They're opening up all these other things. But when I talked to Phil Blancato, an amazing guest today, he's actually completely changed the mold of what the immigrant mentality does. Phil now runs one of the largest asset managers on the independent channel across the world. They're managing over $5 billion of independent asset management. He didn't want to work for Goldman Sachs. He didn't want to work for JP Morgan. He didn't want to work for any of these institutions that I don't love. But it's a beautiful thing when you see somebody, a first immigrant, first generation American, nobody in his family went to college, and now you're running such an enormous company, and it sounds like you're running one of the fastest growing asset managers in the country. Mm-hmm. Thanks so much for coming on. Thanks everybody for listening. We're really excited for this. So Phil, if you can give us a 2-minute background about you. And
Sure. Kind of a funny story. I grew up, mom and dad, as mentioned, were from Italy, and I didn't want to go to college. It wasn't my thing. And for me, my dad said, listen, I couldn't go to school. I left school in the 6th grade. So go to a local school and learn how to run a business and then make your way to finance. And sure enough, I went to Kane University, a very small school in New Jersey, very inexpensive. Played baseball there. I was an average baseball player, but had some fun. I had an economics class and my eyes lit up. And the next thing I know, a few years later, I'm applying for a job at Prudential Securities. Really started my job. I was very good at math. So I was calculating performance returns by hand. This is 1990. There were no computers. Your dad and I remember this. There was no internet. There was no email. There was none of that.
The abacus.
The abacus. We had HP calculators that we would type things in. And I was pretty good at it. So honestly, the key for me was I learned from my mom and dad that the only way to really succeed is to simply outwork everybody else. It doesn't matter how smart you are. If you want to put in the effort and the time, you'll win. So here I am 34 years later, and I get to advise on $700 billion in assets, 20-year track record, one of the fastest growing managers in the industry. We manage billions of dollars today for over 25,000 clients, and it's an honor for me to do what I do. I look back on where I started, and it's been about having, I think, good ethics, good people behind me, a support system that allowed me to be myself, realize that you learn from your mistakes teach you more than your successes. And most importantly, if you have good relationships with people, you're going to win together. And markets to me have never been that complicated. It's if you're not emotional and you realize that things are somewhat cyclical, they happen again and again and again, and you focus on how to lose less money first and make more money second, you're always going to do well. And those are my guiding principles, and they've got me to this point. It's been a real win for me. I couldn't be. I've never worked a day in my life. It's an honor for me to do what I do.
So I would say, we've heard you speak a couple of times, and you are really excellent at simplifying possibly complicated subjects. And that's what I found myself. I was working in a hedge fund myself for a while. I went to business school, but you were able to simplify complicated topics and to make, to get to the core of it very quickly, which was great.
Thank you. I mean, if there's one thing we focus an enormous amount of time on, I do, is that, I don't know it needs to be so complicated. We don't use jargon that confuses people. It's really simple, right? We know simple math. A lot of this is common sense. And for me, if I can help folks understand that, take the emotions out of it, where do people make mistakes? They buy when the market's too expensive and they sell when it's cheap. Well, let's just teach them that's not the right way to do it by getting emotions out of the way. And we do that with simplifying topics.
So that's exactly where we're at as well. I had a couple of clients this morning. One is a truck driver, and his wife works at a claims insurance, just to simplify complicated products to them, just to go through it. Don't overcomplicate something that doesn't have to be done. It's amazing.
Yeah, it's fun. And when you get a note from someone that says, hey, I got to send my kid to school, or I got to buy that house, or I got to go on a vacation because of what you did for me, there's no more gratifying moment. And that's where that honor and that
you're really helping people.
It makes a difference. I think we do some cool stuff.
It's interesting when you're looking at financial markets. Primarily, people who need simplification are typically going into real estate, but real estate is not the asset of the century. It's a fine asset. It's a good asset. We like real estate, but when they talk about the markets, they go, "Oh, I don't understand the markets. It's really too complicated for me." But what I really like that you're saying is that you learned that and the first thing you said is the markets are simple. They repeat. They'll do well over time. And if you don't get emotional, if you don't buy at a bad time and you don't sell at a bad time, then you're actually going to do pretty well. Mm-hmm. It's very different than your typical upbringing, because we're immigrants, so immigrant mentality is buy property.
From
What
Canada.
are you
I
doing?
don't know if that counts. But okay.
He's
From
from
Canada.
he's from Canada.
You're from Canada too.
Yeah, but whatever. We have the Middle East.
Canada.
I have the Middle Eastern mentality. My father-in-law still puts cash in the carpets and rolls them really, really tight. So it's pretty funny.
You shouldn't say that. What if someone goes to your father's house and tries to take?
He's got a lot of carpets.
Oh my
He's got a lot of carpets. So he probably has like poison in there that you open on up and that pops and it gets you.
This is terrible.
But
I love hockey.
no, he knows what he's doing. But it's very interesting that you're able to say why are the markets simple? I mean, how are you able to simplify such a complicated structure and financial strategies? How should people be looking at the markets? How would you explain to people, okay, I want to invest, I put my money into the S&P 500. That seems simple.
Yeah, I'll give you, it's real simple. I break it down to one easy equation. Risk plus time equals reward. The more time you have, the more risk you can take, the more reward you get. That's all you ever need to know. I get why people like real estate. They can go and you can touch it. I own it. This is my building. This is my house. I get it. But guess what? If you take out the broad history of real estate, you know what real estate makes? Just slightly above the rate of inflation. What does the markets make? On equity markets, the last couple hundred years, around 8% on average. What did we do the last 10 years? 11%. What did we do the last 15 years? 15% in most of those years. On average, for every 3 years up, you have 1 year down. Risk plus time equals reward. Where does that get me? If I'm willing to accept that I've got to be patient and not emotional, I'm going to have real success in the stock market. That's how real wealth is created. And your dad and I know this a bit more than you because we're older than you. When we grew up, the ultra wealthy got to play in the stock market. The mom and pop didn't. The beauty of what's happened in the last 30 years, this explosion of ability for people to go into things like all different types of investments in the easiest of manner.
There was never such a thing as a day trader. What was a day trader?
Didn't exist. You had then the 70s were a handful of stocks you could buy. Now here we are with all these methods to be invested in markets and let your assets grow. If you understand risk, because time equals reward. What does risk mean? How much are you willing to let it go up and down? If you say, yeah, I don't want to lose money. Okay, well, we're going to be conservative, but we're going to make less money long term. But if you're willing to accept that there's going to be years like 2022, which was terrible, but then we have this amazing fourth quarter in 23, the broad span of things were flat. Well, guess what? Over the next 10 years, 12 years, we may double our money. And that's just based on averages. So where do you start with this business? History. History is your starting point because it does repeat itself here. Then you understand what's happening today so you can fine tune your assets a little bit. You and I have had these wonderful conversations about what's happening today, interest rates being where they are. Heck, I can go buy CDs and do really well. Well, that's an opportunity you make now. So you can't fall asleep at the switch. Risk plus time equals reward. You want to be engaging in your portfolio. You want to hire someone who can help you if you don't understand it, but it's not complicated. It's just about understanding, start with history, learn where you are in the markets, be patient, and you will have success.
We come across people though that they say, especially for you and I, we know like in the 70s, 80s, people on real estate made 10 times their money. So they think that's going to happen again. Mm-hmm. They think that, real estate, I'm going to triple. I bought something for $1,000. Now it's worth $100,000, which happened, but that's not going to repeat itself.
We've had these moments in times where there's been a flush of money come into the marketplace. And you saw go explode. Think about where high housing prices went pre-2008 and then obviously settled back down. In the last 3 years, pandemic, housing prices are up 30%. So you've had this run again that reminds me of back then. But why? Because you have a really limited supply of new homes being built. Guess what happens on the other side of this? Interest rates are eventually going to fall. You have a lot of houses coming to the market. All of a sudden, housing is going to stay stagnant for 10 years. We don't get that in equity markets. We get consistent return year after year after year. You may have a down year. And guess what a down year is? Your best buying opportunity. Personally, when was in my career now spanning 34 years, one of the best buying opportunities I ever saw, two of them actually, was 2008 and 2020. I leveraged everything I could in my life and went into the stock market because I was getting great companies at a 50% discount, 75% discount. That's where you turn to us, let us take the emotions out of the way. It's an honor to manage your money for folks. You two started, right? You know who these people are. You help them get to a point where this is your money. Let us be your caretaker. Where we're not going to get wrapped up in the latest headline of who might get elected or who might not, or what's happening in the world that's geopolitical. What's happening with some nonsense noise or what station are you listening to, or what are you looking at your phone that's upsetting you? Well, we don't do that. If we use history as our starting point, focus on where markets are at now, over time we will make money.
Well, we always say also, investments perform, investors don't.
That's a great point. You're spot on.
So a lot of questions I have. First thing that you said, the real estate market has over the last 3 years has done 30%.
Mhm.
That's 10% on average a year. You said the equity market has done an average of 9% a year. So
11 over the last 10 years, 11.
Oh, over the last 10
11.
years on average. So even with a real estate pop, the equity markets have done 11%. So you're still outperforming it when the real estate does really, really well. And who really knows? Because in the end of the day, there's construction work, there's all this other stuff. So the price of your actual property might have gone up, but there's also a lot of work that you have to put into it because there's manufacturing issues, there's price of supply chain, there's all this other stuff that's coming into the geopolitical conversations about China and the Red Sea and whatever it is, and that's actually affecting your real estate. So we find that real estate is a great asset, and I own property myself. I'm invested in property. I love property, but we love diversification. And I really like looking at these specific numbers. It's, I doubled my money over the last 30 years in this property. It's okay, well, you could have 20x or 10x your money if you put your money into the market. And it's not saying that one is better than the other. It's just saying that having a little bit of everything is really, really important. Now, you're a third-party asset manager, and what's become really, really popular now are these so-called robo-advisors, Betterment, and all these other ones that I don't, Acorn, and all this
maybe
other
you should
nonsense.
explain what a third-party money manager is. Maybe you should define that term for our listeners.
And also, I think what would be really good if we can get a sign language translator to because you talk a lot with your hands, so maybe you're speaking something else. You're like, I hate these guys. For anybody who's watching right now,
somebody knows something.
There's something that there's like 2 or 3 conversations all happening with you at the same time. So we just got to make sure that we're all on the same page.
From the same ilk. We care about our families, right? Jewish, Italian, same thing, Catholic, whatever.
Pizza bagels.
Well, what happens when we're all in a room? It's really crowded, right? And what happens? The boys level goes up. So the only way you get your point across is if you use your hands.
That's true. You got to get multiple conversations going at the same time.
That's how it works. But there's pasta on the table. If you don't get your hands going, you're not going to eat or talk. But 2 questions in there. First, a third-party money manager. Let's break it down to 3 pieces. Here's you, the client, the folks that have need investments. They meet you two. You guys come in and you're able to, deliver advice, whether it's insurance advice or investment advice. So you're their most important piece of it. You're the quarterback of a football team. Then you need players on your team. I'm one of your players. So I might be your running back. And what that means is, folks, you have money to invest. You turn to these two for help. You go to client and say, I need help. And let's assume it's investments. You have whatever, a couple $100,000 you want to invest, $1 million you want to invest. And then they say, okay, based on your risk, your time, and how much you want to make, let's go out and build you an all equity portfolio. Well, then they turn to an expert on how to do that. And that's where I come in. So I'm behind the scenes. I work, really, my boss is the 2 of them. So you are my boss in that way, that I work for you all. So for you, the person out there that's listening, it sounds complicated, but it's not. It's real simple. You need help. You go to people for advice. They give you advice. And once they know what advice you need, they can come to me and I can help them invest that money into the market.
Yeah, and we find it much more impactful for clients because in the end of the day, we can't be managing specific dollars and cents and buying more and buying. We find it honestly irresponsible for clients. Yes, we could do it ourselves, but we much rather bring in third parties to do that. We bring in institutional clients. Can't go directly and invest in your assets. They have to go through advisors because you really need vetting. And the nice thing is that we can say, okay, well, here's 30 different strategies. Let's really customize to the clients, constantly being actively managed and traded and really taken care of. And if you don't like the asset manager, you can move to a different asset manager. And it's a beautiful thing that people are not realizing. Like the beauty of these products is that, and advisors, that they're giving you this independent advice, and they're really they're looking at you and creating customized portfolios that are designed. It's not just sitting in a big bank and everybody goes into the same fund. You're really able to do something different. Right. You were answering the second question, so I didn't want to.
And I want to tie into that for a second. When your dad and I started a few years back, you really could just buy a couple of stocks and forget about it because it really was market wasn't, 1, as big, and 2, there were not as the complexities of today's market are a bit different. So the beauty of it is the day of buy and hold mentality, I think, are gone. So what we're going to do is you're going to provide advice. But the reason why I think you have to be active in your management is to reduce risk, because there are risks that have come up in the last few years, like 2008, for example, like 2020. In certain environments today that are a bit different, being active in your management doesn't mean we're charging more fees. Doesn't mean we're charging you to buy and sell. It means there's times when we might raise a little cash in a portfolio. There's times when we want to change one investment for another. Why? because there's options today that we didn't have 30 years ago. So we can build a better portfolio that's more risk averse. Back to my equation.
And take advantage of tax harvesting, tax strategies.
I was even going to say that. Thank you. Yes. Tax strategies, mitigate risk by changing investments, or just something that's not meeting expectations. Geez, gone. Well, that was come back after it went bankrupt and started over again. Think about how many Apple went bankrupt 3 times. You don't want to be Tesla. For everyone who loves Tesla, think of the competition that's being forced upon it right now. Does that mean it's the only stock you're ever going to own? Probably not. So being active in your portfolio gives you a chance to do some cool things without charging you more fees to do it. We can mitigate risk, bring down your risk, have less risk by looking at what options are available today. And that's a piece of it as well. So we're add on this advice component, being in the market, but also making sure that we're making sure the investments are right for today.
So it sounds like we're the general contractors of the money management, and we're bringing in our subcontractors to run it.
He didn't like my quarterback running back.
We're hockey. If you had said something about the goalie, and then it would have been, and I would have.
We're Jewish.
I grew up in Canada, so it's hockey for me.
We're the team managers. I think it was a little bit insensitive to think that we're actually.
Do you have enough water?
There's a lot of great Jewish athletes that are playing football in the NFL.
Sure,
they're like
baseball.
very little Jewish.
They
just
as a percentage of all.
Stereotypical. Oh, okay, maybe it's a percentage. That's
yeah.
right.
Find me 5 Jews.
Wasn't Edelman Jewish?
Okay.
Yes. Wow,
And he's one of the best receivers ever.
You got one guy.
All right, general contractor.
Thousands, right? Contractor, business owners. All right, we can talk about it. I just think like team managers, team owners.
Okay, you're the owner and you hire. I'm your coach.
Fine, that's better. That I think that would be more appropriate here.
All right, I'm sorry.
I do like football though. I do like football.
See,
we like watching
weekend. We're coming up on football weekend. It's a big football weekend.
It is a big football weekend.
What was the second question? I forgot.
Are we playing soccer? Because I just Messi. Is that what you're talking about?
Like
big
soccer.
Big soccer.
Yeah,
I'm not
big
a
soccer.
soccer.
Yeah,
It's hockey and football and baseball.
I'm a Devils fan. Brodeur, my favorite.
There we go.
Ever. There we go.
Yeah, he's amazing.
They got a great guy. Great goalie. But my opinion, best goalie ever. But I know other people might disagree with me.
All right. If you ladies want to just hang out, I can leave now.
I can go back to Jacques Plante, Bernie Perront.
Tell that
days of the goalie Mac.
Tell that classic story you've told every single person. I remember when hockey.
I remember when I as a Leaf fan growing up in Toronto. That's when the players didn't have any helmets. They didn't wear helmets, and it was just when the goalie masks were introduced.
Oh wow!
So there was. I don't know if you remember Jerry Cheevers played for Boston. So he was one of the first ones. He put a mask on, and every time he got hit in the face, he would put in a scar to show where the scar would have been if he hadn't had the mask.
Wow!
And if you look back, I didn't tell you this. Gump Worsley was playing for the Minnesota North Stars at that time. His face was just smashed and mashed like a complete fighter because he didn't have the mask.
Huh? Oh, do you know David Rosenberg? Question for another day.
I know seven David Rosenbergs.
Well, there's
a very common
economist
name.
who's Canadian, who's a big hockey fan, and he's a great economist. Was once the CIO for Merrill Lynch. Really impressive guy. Someday we'll have to talk about David. He's really get him on your podcast. He's a very talented man.
If you can set him up.
We can try.
Bring him in. Yeah, why not? So the traditional market is constantly looking at the Goldmans, Merrills, Morgans, stuff like that. How are the independent? I mean, you're really the independent asset managers. How are you guys competing against these behemoths? I mean, you're now become. I wouldn't say you're a behemoth, but you're comparatively. But how are you competing against those? And when clients are looking like, oh, I want to go, I have my guy at Morgan Stanley. And you go, well, I have my guy at Ladenburg. How are you competing against that? How are you having those conversations with advisors or with end users?
That's a very powerful question, and some of the folks might be surprised at my answer. First, we can do whatever they do. The talent pool that we have is as strong as theirs. Second, they sometimes are limited in their investment ability because they're who they're owned by. They're owned by companies that have big investment banks that play a lot into what they're allowed to do and not allowed to do. We don't have that scenario. And third, to be quite honest with you, fee. I can win on fee every damn day. You all get your fee. I don't have to worry about charging the exorbitant fees they do. Why? Because we're an independent money manager that our focus is relationship. We want to win with you over time. So we're willing to be less expensive. We're willing to win on fees to make you realize we're a legitimate player, but show you our track records, and in some cases go back as much as 20 years, and we're better than almost all of them. And in fact, in the last 2 years, we're basically number one in almost every category. Now, performance comes and goes, in fairness. But in the end, if we're going to win on service, and we can do what they do, and I would argue better, but we're also going to charge you a fee that's fair, then suddenly you have a real interesting story about someone who's in it to be partnered with you because we make more money as you make more money. And that's a very big difference for some firms. So for us, we want to be a partner to the client. So we want to get the fee conversation and make it fair. We want to tell them we can do everything they can do when we've proven it. And by the way, we outservice anybody. As a CIO, CEO of the company, do you know how many clients I meet with on a regular basis? When you two want me to meet with one of your clients, here I am. And that's different. You're going to meet with the CIO of Goldman Sachs? Not a chance. You meet with the CIO of JP Morgan? Not a chance. Where we care about these people. I'd argue we're the Main Street money manager. They want to go worry about people who have 10, 20, 30, 50 million. Go for it. What are the three of us going to do together? We're going to go help that person who's got $500,000, got 250 million, got $1 million. And we're going to outservice them and be fair on fees than they could ever be.
Yeah, it's very deep because you're talking about doing something a little different. You're the brand behind Merrill, Morgan, UBS, and I find that brand was really, really strong for a long time. But after 2008, I felt that, and I worked at Merrill for a little while and I hated it. But the brand after 2008, everybody realized, they can't protect us.
That's exactly right.
And there's other alternatives out there. So if I can find somebody who's independent, works in my best interest, doesn't sell me products that like you're one of the many asset managers that somebody can use. You're competing against many asset managers. Somebody goes to Merrill, typically they're getting the Merrill flavor of the week. That's right. And it's
exactly right.
Not that the Merrill Lynch advisors are bad, not that the Morgan Stanley advisors are bad. This is just what they're offered, and there's a lot of compliance and a lot to it. And yes, they'll do great over time. But if you find the independent advisors, there's a huge market for people who are really creating customized strategies around you. Are you competing against, let's talk about two more questions on this. Let's talk about the robo-advisors. So people who want to go into Betterment and pay 15, 20 basis points for their aggressive fund. How are you competing against the low-cost advisors? Because you're competing against the big-cost advisors, now the low-cost advisors. And what do you tell clients who just say, I want to go into the S&P 500?
All good questions. I put it together in one really important piece, that if you go into a Betterment, guess what you don't have? You don't have climate. They don't have you two. They don't have the people giving advice. The most important, honestly, what I do, you said it, I'm a commodity. There's thousands of firms that do what I do. I'm somewhat irrelevant. There's a lot of different ways you can do it. And by the way, Betterment fees and my fees are about the same. They're a low-cost robo-advisor. We use low-cost ETFs. We charge a small fee. It'll be net about the same. What's the most powerful thing someone needs to do? They need to hire a financial advisor who's going to actually guide them, give them a plan, and put them in a place where they're going to succeed based on the long-term risk, reward, and get them to that idea of what they ultimately wanted. You're the most important part of this.
Well, we always say we don't have any prepackaged solutions, that we know everything is going to be customized. We're in the same wheelhouse as you. We're looking to build a long-term relationship. That's what we want.
And that's what matters most. Yes, we do a very good job competing against the Betterments. Why does Betterment not work? In my opinion, they've got a couple of bucks, big deal. It's because they don't have that idea of helping somebody understand what they're getting. What advice do I need? What is it going into? And then continuing with it, where you two start that, and I simply support you, so that the three of us together build up a model that I think is almost impenetrable. Why? Because you, the end person out there, is going to get the advice and counsel they need. They're going to get the service they're looking for, and they're going to get it for a very fair fee. That's what matters.
Yeah, I think being honest with your clients. So what about clients who say, I just want to put my money into the S&P, low-cost index funds, the Warren Buffett mentality, even though Warren Buffett charges significant money to manage your assets, but tells everybody else, if you're not giving it to me, put in the S&P 500, which I don't necessarily agree with.
So here's I'll agree to disagree in this way. In the last 10 years, that person was smart. That's all that mattered the last 10 years. But in history of markets, that's not the case, because you want to have balance between your bonds and your stocks. Why they counterbalance each other most of the time, not all the time, most of the time. And you want to know, when should I be more in stock and more in bonds? The last few years, yeah, S&P was great, no doubt about it. What's going to happen in the next few years once all these federal governments stop printing money endlessly, which now they kind of have to? So we're in a scenario where you could buy small cap stocks, which sometimes by 50% or more outperform the S&P. Do you want to miss out on that? Or go buy bonds today, which are earning 5, 6, 7%. Do you want to miss out on that? Think about the bond market right now. It's almost a free trade, free risk, almost no risk. Why? I can go buy bonds that are going to yield more than the rate of inflation right now. And if interest rates go down like we think is going to happen, I make money. But let's just say interest rates go back up. Let's say I'm wrong. Well, guess what? On the yield I'm making, I don't lose any money. Go one further. You've never lost money in the bond market anytime the Federal Reserve has stopped hiking rates and started to cut for the next 1, 3, 5 years, in some cases 10. So you tell me history, starting point, tells me that when the Federal Reserve starts to cut interest rates, I never lose in the bond market? Yeah. So that's why just in the S&P, you miss out on a bond trade of a lifetime. You miss out on maybe going into small caps, which are a great asset class when the economy.
Can you define what a small cap means for our listeners?
Sure. Think of a large cap is Google, gigantic company. A small cap is a company that does $1 billion a year in revenue, maybe $5 billion. Who is it? It's your mom and pop bank. You know that bank on the local corner that you may not know the name, who services the local business? That's who we're looking to buy. Someone like that who is benefited by the local community. Someone who's going to have a regional trucking company, a regional manufacturing company. Names that you probably know better than me. And for lots of reasons, we can't get individual names as which ones you should buy. But why those names matter? Because what do consumers do when things are okay? When they're not worried about the economy, they're not worried about runaway inflation, they're not worried about losing their job, which is probably a lot of the conversation for the first 6 months of this year. When we get into a growing economy, a really expanding one, they go spend in the local community. That's what we want to make money on. An expansionary economy is great for small caps. Do you want to miss out on that? By the way, simple analogy. I walk into a food store. Right now, those magnificent 7 stocks are really expensive. What does that mean in simple terms? The most expensive item in a food store is usually the one on the top of the shelf. So when you go to the food store, what do you usually do? Well, you don't always look up top. You look on what's on sale. You know what's on sale right now? Small cap stocks. We look at a price of a company divided by how much they make. And if you look at that, those big 7 names, which are great companies, are really expensive. Where do I get value? Where do I find a bargain? Where do I find things on sale? Small caps. So it's about that risk management. What's less risky? Buying something that's on sale because I'm getting a better price than something that's really expensive.
Yeah, I also really like that. If for clients who have put into the S&P, let's say in 2022, they were down, the percentage better than I do. Let's say 25% or 20%, whatever number they were down. If you're a retiree and you're taking out income every single year, or you're just the people who say, "Oh, I'll just put my money in low cost index," like, what does that work around you? What does that customize? If you need to take out income, or you're saving for your kid's college, or you're saving for a home, and you're putting your money in an index fund, and all of a sudden the market crashes and you're down 28%, are you going to be able to afford that? And that changes your whole life. I mean, I remember watching Boiler Room, and he pushes his client, this guy, poor guy, to put everything into a stock, and it comes down, and then they go. And the thing that woke me up is like, oh, well, we're trying to buy a house and now they can't buy a home. Happens even in going into big cap, into the index funds, that the market comes down, you put everything into something that wasn't designed for you. And then the market came down, then you're ready to buy the home, and then you don't. And then obviously things got worse from there.
But you're just hitting on why people don't invest, by the way, because they watched that movie or they heard that story from someone.
The Bernie Madoff.
That's where, think of the layers. They're layer one. You're layer one to make sure you're going to sell them insurance as an asset class.
Yeah.
That's a great way to protect. Maybe buy a bond portfolio for the money that you got to save for the retiree. And then there's maybe a slice that's the next generation. That may be that person's grandchildren, that money has a 10-year time horizon before they need to touch it, or a 15-year time horizon. Well, that's your equity money. You see, everybody comes back to kind of where I started. One, diversifying your assets, having experts who can give you that financial plan. But then when it's time to put in the market, which bucket is matter for that house or my retirement, or which bucket is for 10 years from now or more. It's about knowing history. Yes, there's years like last year when the market got clobbered. Well, 22 now. And that's understandable. That's why you can't say, I'm going to go into stocks and have no risk. That's not the case. Sure, you can adjust it and change it, but even the best money manager lost money last year in equities 2 years ago. So now you have to ask yourself, it's about building that pie chart. A little bit in real estate, like we talked about before. Certainly insurance is a way to protect yourself, especially when markets are volatile. Bonds that are going to get me that reoccurring income that I need to go and live a better lifestyle. Maybe I go buy muni bonds that are tax-free. If I don't worry about taxes, maybe I go buy corporate bonds. And then I buy some stock. Why? Because that's my best return, but my most risk.
Well, I like what you said before. I mean, we're trying to develop a relationship. I think the most important is what you said before. We start off with a plan, make sure that we are able to manage the investors' expectations and emotions when things don't go according to what they think it should, go.
Exactly.
So that's part of what you need an advisor for, just to make sure that when you put together a reasonable plan, and you stick to it over time, because that's what's going to happen.
And I like what you said, you put together a plan. Your plan can change.
And it should be, but that's what we're here to do. Let's tweak it. Let's look at it. Have things change. What changed? How do you want to go about it? That's what we need to do. And I think that's the way to be, to successfully grow your wealth.
Couldn't agree more.
All right. So going back to you, so you obviously came from humble beginnings,
Mhm.
or I don't know, people go like, oh, I got here, I came to the US with 2 cents in my pocket, but like 8 million in the bank, because their pockets were just filled with
My
watches
dad
and
was World War
jewelry.
II Sicily without a penny.
It's
so,
the
yeah.
classic. Hey, I have 2 cents in my pocket, but 2 buildings that I had to live in. And, ooh, you really struggled there from coming from Iran. But what was your like defining moment in your life? What would be that moment that allowed you to constantly push and allowed you to constantly enjoy? Because all I've ever seen from you is just like, I mean, yes, the financial services is tough, but like you enjoy your life, and there's something, and there's this level of resilience.
You're always positive.
You're always positive. You're always,
up.
and yes,
You're always
you're in sales,
enjoying,
and we get that. But there's also a core personality. And if you can be vulnerable for a second, what was that defining moment in your life?
That's actually really easy to answer. I'll go 2 ways. First of all, my second favorite day of the year is December 21st. Why? It's the shortest day of the year. Every day after that, there's more light. It's brighter. I'm built to be an internal optimist. It's how I'm built. And the reason why I'm an optimist is I have had so much love in my life, because I come from people who literally were poor. My father's father died when he was 2. We came here with the money they sold a pig in Sicily to get him on a boat to come here. And for every dollar he made, he sent 75 cents back to Sicily and survive. My mom came with her dad, and my grandfather worked in the mines in Pennsylvania. And then eventually they made their way to New Jersey, and my mom and dad met in New Jersey. So when I say the love that I come from was because my upbringing is backyard barbecue with 50 people at my birthday party. We ate off the gardens that they planted and the food that they made, and that was great. So for me, my defining moment is I'll never fill my dad's shoes. My dad passed this past April. He's the greatest man I've ever known. He had zero money in his pocket. And if you hear, I can tell you stories about how powerful a man he became mentally and physically. But by the time he passed, it was worth probably $3 million. So I'm in college sitting there, and I realized, oh my God, I come from people who are incredible aunts and uncles who made lives for themselves out of nothing by this hard work. And you know what? I couldn't walk away from that. I could not honor that. So for me, it was my defining moment was realizing I'll never be as great as they were, but I come from greatness, so I have to respect that and honor it. So that's why I am today. And then it made me an optimist because, the market fit my mentality that it's more up than down. So I think I just try and get folks to understand that this is the greatest way to live a life that you want for your children, for your family, for yourself, to make investments. And look, the stock market doesn't call me up at 2:00 in the morning saying my heater broke, right? So I'm not much of a real estate guy. I get people like
Yeah, we're the same. I hate headaches.
Yeah. But my point is to be a bit vulnerable. I'm an average guy. I went to a small school. It's not a finance school. I did some postgraduate work at Wharton and NYU. It was not a big deal. I've just learned that I've been competed against people in my life that were Wharton grads and NYU and Columbia and all these really bright people. And the only thing I can ever come back to is it's an honor for me to do what I do because I come from great people, and I don't want to let them down. I don't want to let myself down. And that's it.
You're humble. That's
a beautiful legacy.
You're a humble guy, and that came obviously from your parents and the grandparents that sold that pig in the first place.
They did, yeah.
That was probably like the most part of their assets at the time. That probably made up 90% of their wealth, and they sold that pig.
That's exactly right.
So we're gonna play a quick game that we're only playing this game with you because it is an Osaic game that we got at the Behavioral Financial Advisory. So if you take these 52 cards, there's 52 values in this deck. Take out your core top 10 values in this deck. There's stuff that you're going to like and that's important to you. But
There's some overlap also, but some might fit with the other.
It's not going to be your core value. So try to get these down to 10. We don't have much time, so I just want to make sure, and we want to be cognizant of that. Okay. I want to make sure that we get to that point where we find your core values, and then we'll call it.
Okay. So I just flip through each.
Just discard each.
Okay.
So the good ones. Yeah, that's it. There we go. No judgments.
That's a tough one.
No judgments. Don't worry.
They're all good. It's hard to say which one of these. I'll start with this one. Independence is a very good one for me.
Okay.
Ability to be self-directed.
Let me have that one.
That's a good one.
All right, all these are going out.
Oh, okay.
He's reviewing. He's reviewing.
This one, I'll say what's not important to me. That's not important to me. This is important to me. I'll keep that one in there. This is not. Should be, but it's not. Regrettably, that's not. That's not. That is, it's kind of hard not to be. Meaningful work. I'm not sure what that means yet. Status. No, that's
Remember, you got a lot more to go.
status is baloney. Anybody thinks they have status is an idiot. Privacy says, okay, so I'll make this quick. Order. Money. This is the worst card in the deck. If this is meaningful to you, you need to.
My mother-in-law put that right in.
We said no judgments. We said
I
no
understand.
My
judgments.
mother-in-law
You know
put
what,
money
you're
right
I
in there.
shouldn't- I shouldn't do
No care in the world.
I
Money
shouldn't.
was right in there.
that. I shouldn't do that. That's important. I would put faith in.
You choose. One's overlapping the other.
Relationships. Family, there it is. Okay, I'll stop there. That's pretty good. That's
Let's
quick.
see what we got here.
Oh, integrity, got to keep that in. That's
Yes, thank you.
How many? I might be more than 10.
Definitely
we
more
got
than
here.
10. But we'll
One,
just
2, 3.
keep knocking them out while you're going.
Take now out of these. Take the top 5.
And while you're looking through this, I think what I find most impactful, number one, about what you've done and what I'm taking away from this podcast is that you don't have to be this Wharton grad to run these huge financial firms. If you want to make it your dream, you can make it. It's really about your work ethic. It's really about your mentality. And I find it to be really about your values. And if you're a good person and you do the right thing every single day, right will follow you and good will follow you. And if you continuously push yourself, you're really going to get to another level. On the second side is putting money, building a life for yourself and building a life for your family is enormous. And you can do that in multitudes of ways, and just making sure that you're actually putting your money in places and making sure that it's working for you and not being scared of the market is such an important piece. You got one more to carry out, but
Okay.
Phil,
I would say it's even further than that. I mean, I would say go back to resiliency. What resilient riches really means is that if you're true to yourself, everybody, no matter what, I'm sure you in your career path, there's always ups and downs. So while you're going through the downs, that's when you need that resiliency. And if it's something that you're true to yourself, it's okay for you. You can do it. You're not giving up because you know this is who you are. So when you're on your down, you're using your resilient riches. That's going to see you through those times. You know, everybody's got good times and bad times. Everybody does.
Yeah.
You can't get away from it.
For sure.
But the resiliency will see you through those bad times because this is who you really are.
So the reason why I get family in there, and family to me is defined by not just my immediate family, but the friends that are family to me. In my worst of times, it's that. So when I struggled and going up against people who are much smarter than me, or just bad times in my life, just my dad recently passed was incredibly difficult for
Very
me.
hard.
So that's where that pillar of strength comes from. So not only the motivation to be who I am, but also in my times of deepest need, that's where that mattered to me. And I would do family, friends as one group there.
Sure.
relationships.
You know, in the end, the relationships that you have are, I think, a byproduct of what you want to be. So my relationships with people that I have are emblematic of the person I'd like to be, but also people that I admire and to a degree honor. So I care about friendships much more than and relationships much more than really anything else. The sphere of people that I have, the bigger I can make it with strong, not just acquaintances, but tying relationships. It's what I think the most powerful thing in life. When do we get our enjoyment? Our relationships and how we share together, whether we're being philanthropic or just enjoying ourselves or just talking or just going out for a meal. That power of community, there's nothing more powerful in life, nothing more exciting. That's the stuff that matters. Not how many dollars you have in a bank or what your title is. That's all not great.
You can curse.
Okay. But that to me is about the community that we're in, and that makes it fun. Look at our relationship. You know, we barely know each other, how much fun we have already. I mean, that's cool. Work is who I am. I love to work. I've never, like I said, never worked a day in my life, but from a little kid when I had to work for my father, I love to work because to me, the gratification of succeeding, you can't understand how powerful it is. And I liken it to this. I think today's world's a little different, right? Where there's this, they want a work-life balance. I get it. I understand that. Folks want to do 50-50. But work to me was this place where I could gratify myself and see results and the power of it. And then, by the way, I get to help others through my work. It's incredible.
Yeah, you are helping others.
It's gratifying.
Excellence.
Excellence is a pursuit that in every aspect of our life we try and get to. And I would say excellence, I'd make it maybe grow. Because excellence and grow are kind of similar, but not exactly the same. I think we always want to grow. And grow is certainly grow your
I
business.
mean, Excel is really
Excel because
Or always improving.
always improving. And by that, it's easy to get lazy. And I know I try to keep physically, I try and stay in pretty good shape. Mentally, I'm always trying to improve my relationships, trying to learn. You know, I'm going through some estate stuff right now with my family. Trying to learn from this, trying to be a bigger person, trying to realize what I used to do 5 years ago, what I should do today. That aspect of being excelling, to be better, to improve. It's what should motivate us beyond just waking up and having fun. You still want to improve.
and integrity.
You know, I've made a lot of mistakes in my life, plenty that I'm embarrassed to even admit. So what I've come back to is the one thing my dad and my mom were both, their integrity was unparalleled that I know of. I'm sure they made things I probably never know about. No one's perfect, but you know, there is no such thing as perfection. So if I can be a person that's got integrity, that, you know, tries to do right by other people, then I'm okay. I'm gonna be a decent guy. I'm not gonna be a great guy. I'm gonna make my mistakes, but I want to be a good guy. Integrity means be a good guy. You know, say
We're
please,
human. We're human.
be human. Please, I've in the last couple of years, I've gotten the hang of saying yes sir, no sir, yes ma'am, no ma'am. Why? It's respect, right? That's not something I did 20 years ago, 10 years ago. So I feel like being a good human is a good thing. So that to me what integrity is.
Yeah.
Awesome.
Well, you clearly define what high moral character is, and you really are bringing an honor to your family and to an honor to your legacy. From the pig farmers is what they were. From the pig farmers to
I think
to
they
what
only
you're
had one
doing.
pig. It sounds like they only had the one pig, so
pig.
I don't know if that qualifies.
But you
No,
know what
it's
they
fine.
always did for? I'm sure they always did for others, and they always did for their
They did.
family, and they always did for their relationships. We find relationships very common with high end salespeople. I had a loyalty. That was my relationships. It's just being loyal to people, and that was something that people really appreciate. And it's a similar mentality, but it's really deep what you're doing. That, and we really appreciate you coming and being
Thank you.
vulnerable with us. Not many times you get to sit with somebody who's the head of such an enormous company. And in all honesty, when I first met you, I was like, this is not the CEO. This is like the chief sales guy. Like that's really what we thought. But
That's what I was even thinking this morning.
That's very different. That's very different than most places. So we really appreciate you coming.
Thank you.
Can you give a quick plug where people can find you and tell us a little bit where they can see you?
Well, they certainly can find me through you all, but I'm a regular on Fox Business and CNBC. You see me out there. If you went to LTAM.com, that's our website. We're out there. And I'm on LinkedIn, and I'm on, I have a podcast as well out there. If you're bored and you want to hear just economic stuff, it's on Spotify. It's called Weekly Market Impact with Phil Blancato. I'm kind of everywhere, but certainly reach out to you too. And if someone wants to have further conversation about their investments and want to talk markets, it'd be my pleasure.
Great. Thank you, Phil, so
Thank
much
you.
for coming. We
Great.
appreciate it. Bye, everybody.
Thank you.